Greetings, my name is Mark Schulte, and I'm a pension actuary who's going to review defined benefit pension plans with you today. So, what is a defined benefit or DB pension plan? A traditional DB plan occurs when an employer promises a lifetime annuity benefit to reward an employee's service with the company. If you're not familiar with annuities, these are benefits that pay a monthly income stream for the participant's lifetime. Traditional pension plans are rarely offered in the private sector today, except at very large companies. They are also prevalent in collectively bargained plans for union employees and also for employees in the public sector. Many existing traditional DB plans are frozen, which means that either no new benefits are earned in the plan or that new employees aren't allowed to participate in the plan. Also, traditional pension plans are often underfunded. This means that the assets the employer has set aside to pay for future benefits are less than the total value of those benefit promises. This phenomenon has been compounded over the past couple decades by low interest rates, which increase the present value of plan liabilities, and volatile investment markets which have drained pension trust accounts. These economic conditions have exposed some of the risks of DB pension plans, so many employers are currently exploring strategies to de-risk their plans by getting the liabilities off their balance sheets. Traditional DB plans have mostly been replaced by 401k plans, which usually have lower employer risks. For example, in a 401k plan, the employees bear all of the investment risk, whereas the employer is responsible for investments in a DB plan. I like to think of it this way. In a DB plan, the employer promises a fixed benefit and must make variable contributions to fund that benefit. In a DC plan, the employer promises a fixed contribution, and the employees get a variable benefit. Cash balance plans are one of the few types of DB plans that are gaining in popularity, primarily because of the large tax-deferred retirement benefits they present to professional service firms. We'll talk more about these types of plans later. We're now going to talk a little bit about basic DB plan designs. In a traditional DB plan, the employer promises a lifetime annuity based on the employee's pay and service history. For example, suppose the benefit formula is 1.5% multiplied by an employee's final average pay and multiplied by their years of service. For an employee with 30 years of service at retirement, this would provide an annuity equal to 45% of their average pay. Combined with their Social Security annuity income, this will provide a substantial replacement of their pre-retirement earnings. In a cash balance plan, a notional account balance is created for each participant. The notional balances are really just bookkeeping balances because all plan assets are commingled and individual participants don't physically have their own separate accounts. A cash balance plan generally has the look and feel of a DC plan because participants are often used to dealing with account balances like they have in their 401k plan. It's often claimed that participants understand cash balance benefits better because they're communicated as an account balance, but it really highlights how poorly employees understand the significant value of a traditional DB plan annuity. Cash balance plans do have DB features like an annuity payment option, but the balances can also usually be paid as a lump sum. A sample cash balance plan design might look something like this. The employer will annually allocate 3% of pay to each participant's notional account and also credit the account balance with 4% interest for the year. Defined benefit plans also have several other unique design features. Usually, a participant becomes fully vested in their benefit after 3 to 5 years of service. Once a benefit is vested, then it cannot be taken away. Cash balance plans generally have a 3-year cliff vesting schedule, which means that benefits become 100% vested after 3 years of service. In comparison, traditional pension plans often have a 5-year cliff vesting schedule. One of the most important features of DB plans is that they must offer annuity forms of payment. The 3 most common and usually required forms of payment are a life annuity, which pays a level income stream for the participant's lifetime, a 50% joint survivor annuity, where the participant receives a slightly lower amount than if they had elected a life annuity, but when the participant dies, then their surviving spouse receives 50% of the participant's starting annuity amount for the rest of the spouse's life. This benefit is the default option for married participants and provides additional retirement income protection for widows. and a 75% joint survivor annuity, which works similarly to the 50% JNS, except that 75% of the initial benefit is continued to a surviving spouse. Lump sum options are common in cash balance plans, but are not usually found in traditional DB plans. A final note on required minimum distributions, also known as RMDs, is that they do apply to DB plans similar to DC plans. However, one strategy to consider is if a plan offers an in-service lump sum distribution option, then an older employee nearing the age 70.5 threshold for RMDs could just roll their DB lump sum over to their 401k account or IRA and then take the minimum required distributions from there. Defined benefit plans have very strict minimum required and maximum deductible contribution requirements. This is because DB plans are essentially a form of deferred compensation that an employer has promised to pay to its employees at some point in the future. Since DB plan contributions are tax deductible to the employer, the IRS wants to make sure that these plans are funded responsibly and are not just used as tax shelters. The current minimum contribution rules require that an employer annually contribute an amount equal to the value of benefits earned during the current year, known as the normal cost, plus a 7-year amortization of the plan's unfunded liability. This minimum contribution amount is adjusted with interest if paid after the first day of the plan year. Fortunately, the timing on DB pension contributions is very flexible. They're due no later than 8.5 months after the end of the plan year. We should note that most cash balance plan sponsors choose to make large enough contributions so that participant notional account balances are 100% funded. As we'll see later, this generally requires a contribution equal to the annual account allocations, known as pay credits, plus any investment shortfall during the year. There is also an upper limit to the amount of money an employer can contribute and deduct to a DB pension plan. These maximum deductible contribution limits are very generous and allow up to 50% overfunding of DB plans. This is especially appealing to professional service firms who are looking for large tax-deductible contributions. Because of their unique features and related rules and regulations, defined benefit plans also have a variety of administrative requirements. The most notable obligation is that DB plan sponsors must hire a credentialed actuary to prepare an actuarial valuation of the plan's assets and liabilities. The actuarial valuation is essentially a report which determines the total value of the benefit promises made by the employer to their employees. Based on these liability calculations, the actuarial valuation report also calculates the annual deductible contribution limits. In addition to the actuarial valuation report, DB plans also are required to file a Form 5500 with various attachments, and for many, but not all plans, there are other administrative requirements such as Pension Benefit Guaranty Corporation, or PBGC, pension insurance filings and premium payments, an annual funding notice to participants which summarizes the actuarial report results, participant benefit statements which show their pension benefit accrued to date, and non-discrimination testing. Some of these administrative requirements are unique to DB plans, like the PBGC premiums and annual funding notices, while others are required of DC plans as well. Other DB plan administrative requirements include comprehensive benefit election forms and, sometimes, a plan audit. When a participant retires and elects to start receiving pension payments, many employers rely on their actuary to prepare the necessary election forms because the computations and annuity conversions are very complex. However, larger plans with thousands of participants may choose to purchase the DB administrative system to complete the calculations in-house. With regards to a plan audit, this is required annually when a plan has 100 or more participants. If DB plan sponsors prepare their financial statements using generally accepted accounting principles or GAAP accounting, then they will need annual DB pension accounting calculations. The most important two results are the pension expense and the plan's disclosed funded status at year-end. The pension expense is the amount of pension cost that is recognized on the employer's income statement during the year. The funded status is a comparison of the plan's assets and liabilities at year-end and shows up as a net balance sheet liability or, in rare cases, a net asset. These accounting calculations are covered under Accounting Standards Codification Topic 715, also known as ASC 715 accounting. Because the pension accounting rules are very complex, the plan sponsor will need to have their actuary calculate most of the results. These numbers will be substantially different than those developed in the annual actuarial funding report. This is because the funding report is a long-term view of the plan liabilities and is used to determine the cash contributions to the plan. The accounting results are for financial reporting purposes and must follow a different set of calculation parameters. They are a snapshot view that roughly represents the cost for the employer to settle all of their pension liabilities in the market. The ASC 715 accounting results are the primary concern for most employers. This is because legacy pension plans can have a substantial impact on a company's income statement and their year-end financial results. Plus, the results are often quite volatile since they are based on current market interest rates and a snapshot of plan asset values. Defined benefit plans must comply with many of the same non-discrimination testing requirements as defined contribution plans, but the calculations are often much more complex. Coverage testing under Internal Revenue Code Section 410B tests whether a pension plan covers a non-discriminatory group of employees. These rules are intended to ensure that pension plans are accessible to most employees. For example, many retirement plans must allow both highly compensated employees, known as HCEs, and non-highly compensated employees, known as NHCEs, to participate in the plan. Benefit testing under Code Section 401A4 is the other main prong of the non-discrimination testing rules. It ensures that not only do non-highly compensated employees have access to plan coverage, but that they also receive a non-discriminatory level of benefits. For example, it wouldn't be fair if an employer allowed all of its employees to participate in the pension plan, but gave minuscule benefits to rank-and-file employees while providing lavish benefits to executives. Not only wouldn't it be fair, but the IRS would not approve of the employer getting to deduct contributions to this type of inequitable plan on their corporate tax returns. Some additional testing requirements for DB plans are 401A26 minimum participation rules, which require that the smaller of 50 employees or 40% of the employer's workforce participate and accrue a meaningful benefit in the plan. 415 maximum benefit limits, which are a lifetime limit in a DB plan, in contrast to DC 415 limits, which are annual allocations. And 416 top-heavy requirements. When an employer sponsors a DB and DC plan, which are top-heavy, then usually there is a minimum top-heavy allocation requirement of 5% of pay to each non-key employee. These top-heavy allocations are generally provided in the DC plan. Lastly, I want to highlight cash balance plans, especially those that provide large benefits to principals and owners, and that they usually must be cross-tested with a new comparability 401k profit-sharing plan in order to pass testing. These cross-testing rules are very complex and are generally performed by a retirement plan specialist. The next few slides of this presentation focus on cash balance plan design because those are the primary type of defined benefit plans being created today. Cash balance plans are a type of DB plan where each participant has a notional account balance which looks and feels like a 401k account. Each year the account balances increase two ways. First, the employer provides an annual pay credit, which is the annual account contribution. The pay credit is similar to a profit-sharing allocation and is generally awarded as a percent of each individual participant's annual pay. In addition, the accrued account balances are also credited with interest for the year. The rate credited to the account is usually either a fixed rate, like 4% interest, an indexed rate, such as the current 30-year Treasury rate, or as a variable rate such as the actual return on the plan's trust investments. Visually, this can be represented by the following equation. The balance at the end of the year is equal to the beginning of year balance multiplied by 1 plus the interest crediting rate, plus the annual pay credit is added to the account balance at year end. Cash balance benefits are usually paid as a lump sum at termination, which helps the employer avoid having to be responsible for paying lifetime annuity benefits. Note that the employer cannot force the employee to choose a lump sum payment. Annuities must still be offered unless the participant has a very small account balance, generally less than $5,000. However, our experience is that most cash balance plan participants choose to receive a lump sum when they are presented with that option. Lastly, cash balance plans generally have a 3-year cliff vesting requirement where participants become fully vested in the right to their pension benefit after 3 years of service. It should be noted that cash balance plans must use an individually designed plan document. An IRS pre-approved prototype or volume submitter document is currently not allowed. A volume submitter document option is being evaluated by the IRS, but it's currently unclear how flexible this template would be and whether it would allow the types of large deduction cash balance plans that are currently popular. Where we see the largest growth area for cash balance plans is among professional service firms that are seeking large tax-deferred benefits for their principals or owners. In 2016, an individual can receive up to $53,000 in tax-deferred retirement benefits in a 401k profit-sharing plan. However, cash balance plans allow much larger retirement deduction opportunities. Professional firm cash balance plans are fairly popular among medical groups and law firms. They target very large benefits towards the principals and owners while providing a meaningful cash balance pay credit plus substantial profit-sharing allocations for rank-and-file employees. Let's take a look at a sample plan design in the table below and review the numbers from left to right. In this example, the firm has 3 owners between the ages of 55 and 62, which means that they are later in their working careers. There are also 30 employees who are substantially younger than the owners. This age differential becomes important when the plan design is tested under the non-discrimination testing rules. Those testing rules allow older participants to receive larger benefits than younger participants because the older employees have less time to accumulate a retirement savings account. Moving left to right, we see that the owners all have pension-eligible earnings that are capped by the 401a-17 qualified compensation limit, and the employees have average pay of about $40,000 each. Based on these inputs, the maximized cash balance plan design could look something like this. In the cash balance column, we see that the owners could receive annual cash balance pay credits ranging from $180,000 up to $260,000 depending on their age. Employees would receive a 3% of pay credit. The combination of the owner's profit-sharing allocations and 401k deferrals would also be maximized at the DC Plan 415 limit of $53,000 in 2016. Plus, they are all over age 50, so they could make additional catch-up contributions to their 401k accounts. The employees each receive a 7.5% of pay profit-sharing allocation, which is the minimum amount required to use the advantageous cross-testing rules that allow the large benefits for the owners. This exhibit focuses on employer-paid benefits, so we've excluded the employee 401k deferrals since those are fully paid by the employees themselves. Looking at the total column on the right side, we see that the combined owner tax-deferred retirement benefits for the year are over $850,000. In order to reach these levels, they must contribute around $126,000 toward the employee's retirement benefits. It's up to each individual employer to decide how much employee benefit cost is acceptable in order to provide large tax-deferred benefits for the principals and owners. So how big can cash balance plan allocations get? Pretty big. The exhibit below illustrates the relative amounts available from a DC plan, like a 401k profit-sharing plan, and a cash balance plan. The blue bars represent the employee 401k deferral amounts. The red bars are the 401k catch-up amounts that are available for participants who are age 50 and older. And the yellow bars represent profit-sharing allocations. In total, the yellow plus blue bars are limited to the DC 415 limit of $53,000 in 2016. In contrast, the green bars represent the potential cash balance allocations, which are substantially higher than the DC amounts. As mentioned earlier, the cash balance allocations are limited by the DB 415 limits, which increase as a participant gets older and peak around age 62. Although the DB 415 limits are lifetime limits, you can approximate them with an annual limit. As in the example on the previous slide, late career principals and owners have the largest deduction opportunities. When operating a cash balance plan, it's highly recommended that plan sponsors maintain 100% funding of participant account balances. This means that there is always enough money in the cash balance plan trust account to pay out all of the participant account balances. The reason this is important is that terminating participants must be paid their full notional account balance even if the plan in total is underfunded. In particular, you don't want a situation where an owner or principal retires and receives their full account balance, even though they may not have fulfilled their obligation to fully fund this benefit. If this occurs, then the remaining owners will eventually be responsible for contributing enough money to make the plan whole. Another recommended practice is that plan sponsors select investments that match the plan's guaranteed interest crediting rate. For example, if the plan has a guaranteed interest crediting rate of 4% per year, then plan assets would likely be invested in fixed income securities that are expected to also earn 4% interest each year. If the assets were instead held in cash, then it's likely the underlying plan assets would not be able to earn 4% returns each year, and additional employer contributions would be required to compensate participant accounts for the guaranteed 4% return shortfall. A final cash balance funding item is that there is some room to front-load plan contributions because of the 50% overfunding cushion allowed by the statutory funding rules. This can be beneficial if an employer expects a large one-time source of income and would like to put some of that money in a cash balance plan in order to defer paying income taxes on it. Because of their complexity, there are several pitfalls that employers and service providers can encounter when dealing with defined benefit plans. The next few slides will address some of these issues. One of the most common DB plan problems is poor plan design. A guiding principle is that they should always be designed with sustainable benefit levels and realistic employer contributions. For example, very few employers are a good fit for a traditional DB plan because they don't have the ability to deal with such large investment risks and also potentially volatile contribution amounts. Cash balance plans can work well for professional service firms like doctors and lawyers, but there are some red flags that indicate a poor candidate. These include employers who haven't consistently maximized the DC benefits for their principals and owners. If they can't afford to maximize DC benefits, then it's unlikely they'll be able to afford the much larger DB benefits too. Employers with inconsistent or insufficient profits are also poor choices for a cash balance plan because these types of plans generally require a stable earnings stream to pay for the benefit costs. If there's a high employee to principal ratio, then this indicates that the employee benefit costs may not be cost effective to set up a cash balance plan. For example, if it costs an employer $1 million in employee benefits just to get $200,000 in owner benefits, then this is not an affordable outcome. And when principals and owners are very young or the rank and file employee group is relatively old, this can cause problems passing the plan's non-discrimination tests. Another important pitfall is that cash balance benefit levels should not change frequently. This is not a profit-sharing plan, where allocation rates can change year to year depending on employer profitability. If the IRS audits a cash balance plan and finds that it's being operated like a profit-sharing plan, then they could disqualify the plan's tax-deferred status. Frequently changing a cash balance plan's benefit levels implies that the benefits aren't well defined and violates the definition of a defined benefit plan. Since plan documents are individually designed, they must be drafted carefully. Also, the consultant responsible for designing the plan should understand the type of business so they know the tax consequences of the plan design. Employers interested in starting a cash balance plan should also be aware that there are various administrative costs involved. These include the cost to design and set up the plan itself, including drafting of the plan document. As mentioned earlier, it's worth spending a little extra time and money up front to develop a reliable plan design. The annually recurring administrative costs discussed on an earlier slide, and the eventual cost to terminate the plan. These exit costs are often overlooked, but in reality, cash balance plans usually have a much shorter lifespan than a traditional pension plan. This is because the owners at a professional service firm generally don't start the plan until the end of their careers and then terminate the plan when they retire or sell the business. As mentioned earlier, the Pension Benefit Guaranty Corporation, known as the PBGC, is a governmental entity that insures the U.S. private pension system. In exchange for annual premium payments, the PBGC will take over pension plans and pay benefits if an employer goes bankrupt and is unable to pay the pensions they promised to their employees. DB plan sponsors are required to pay PBGC pension insurance premiums if their plan has more than 25 participants or if they are not a professional service firm. PBGC premiums have increased dramatically over the past several years, leading many employers of traditional pension plans to try and find ways to terminate these plans. Currently, the flat rate premium is scheduled to be nearly $80 per participant per year by 2019. In addition, there's a variable premium for underfunded plans that can cost up to an additional $500 per participant per year. This is yet another reason to keep your pension plan, especially cash balance plans, 100% funded. One trap that cash balance plan sponsors sometimes fall into is that they choose plan investments that are not consistent with the cash balance interest crediting rate. Recall that the interest crediting rate is the rate of return that the plan guarantees to plan participant account balances each year. Because of this guarantee, employers will want to pick investments with a high likelihood of matching the interest crediting rate. One way to mitigate this investment risk is through a new rule which allows cash balance plans to merely credit participant accounts with the actual return on plan assets instead of a guaranteed rate. There are various rules and regulations specifying some limits to this variable interest credit rate, but many new plans are designed with this option. Unfortunately, it's fairly difficult to switch an older plan that has a guaranteed rate over to a new variable rate design, so those legacy plans generally just stick with the guaranteed rate. Non-discrimination testing can have its own set of pitfalls for DB and cash balance plans. The testing results for small plans are usually very sensitive to demographic changes. A good initial plan design will take this into account and allow for some cushion. You must be careful with small businesses to understand whether any of the principals or owners' spouses or children are employed at the company. These relatives are considered highly compensated employees by definition, even if they don't earn much money. This can cause many problems with the non-discrimination testing. Also, control group issues can be a problem if there is a common ownership of multiple businesses. If this occurs, these separate, and perhaps almost totally unrelated businesses except for the ownership, may have to be combined for testing purposes. This can cause many testing problems and be very expensive to fix. Lastly, defined benefit plans should be designed to be permanent. What does this mean? A general rule of thumb is that plan permanency is at least 5 years. The intent of this rule is to prevent an employer from setting up a plan as a very short-term tax shelter and then terminating it right away.